The very first thing that you need to do if you're just starting out, become an expert in one market. There's certain things you need to do. I'm going to lay out 3 things that you need to do to buy your next multifamily. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino, and in this lesson, we're going to be discussing how to buy your next multifamily in this part of the market cycle. Now, as of this recording, we're Q4 in 2025, and if you're getting into multifamily or you're going to be buying your next deal, there's certain things you need to do. I'm going to lay out 3 things that you need to do to buy your next multifamily in this part of the market cycle. Now, before I do that, let's discuss the problems right now and let's discuss the opportunities. Because if you don't see the problems and you fall into one of those problems or you don't anticipate those problems, underwriting is going to be hard, closing the deal is going to be hard. There's going to be a lot of challenges. And what's really interesting when we look at multifamily and real estate in general, there are ebbs and flows, which is what we call the market cycle. There's 4 cycles of the market. Just Google it, go to AI, throw in what are the 4 market cycles. I don't want to get into it in this video, but I'll list them right away, real quick for you. There's recession, recovery, expansion, and hypersupply. Those are the 4 parts. What's really interesting, it's really, real estate is nationwide, but it really comes down to the local economy. What's going on in Memphis, Tennessee is not what's going on in New York City. That's why it's important. I'm already jumping the gun. I'm already trying to give you your first one. Gino, pull back a little bit. It's really important to understand where you are in your market cycle in your city itself. So the problems right now, as we see it, it's as if you're catching a falling knife right now. What do I mean by that? Rents right now in a lot of the markets, a lot of these hotter markets, Phoenix, Dallas, Austin, Nashville, even our market of Knoxville, a lot of markets in Florida. Well, how can rents be falling if people are still moving there? Well, what's incredible is that there's been so much supply come on board. You know, COVID slowed things down, supply chain problems, getting permits, getting money. A lot of these projects are getting done. And right now, over the last 6 months, we've seen an abundance of deliverables. There's been a lot of them that have been absorbed, but there's still an imbalance. And even in these markets where we've had some tremendous, rent growth over the last 3 years, we've had population growing. Well, right now, a lot of these markets, these rents are just either flat or they've dropped. And more importantly, vacancy has gone up. Occupancy has gone down. So if you're buying in this part of the market cycle, please be aware of that. And what we've seen, and I would check out this guy on LinkedIn. His name is Jay Parsons. We've interviewed him twice on the Jake and Gino show. He is excellent with data. And what he's seen in this part of the market cycle, remember, I keep saying this part of the market cycle because every market cycle is different. As we've seen all of these deliverables, the C space, the older assets, they've seen the biggest drop in rents because what's happening is the people that are in the C space can go out and rent a better asset, a better, rental for around the same price point because people are in the B's and the A's. They've got to drop their prices. They're giving 3 months of free concessions. And someone living in a 1970s build is like, I'm paying $1,200 a month here. I could go to this newer asset, maybe for $1,800, but it's not really $1,800 because they're giving me 3 months for free. Oh, and it's 3 bedrooms, so I can bunk up with somebody. So that $1,800 a month with 3 months comes down to 14, let's say, blended, or even 15. Well, am I going to be living in an old asset for $1,250 or $1,295 or $1,200, or I'll pay a couple $100 more a month? A lot of these people are shifting. Now, what's going to happen is by this time next year, those deals are coming due. Those they're going to have to renew. And are those rents going to be elevated or are they not? Is there going to be a flight out of those A's back down to the B's and C's? That's what's going on. So that's the problem right now. Just be wary and be careful of where you're underwriting rents, especially on these older assets. Now, the opportunity. The opportunity is it's really harder for loans to be done. It's difficult to get financing. And we talk about this all the time. Debt is the circulatory engine of the economy. And what we're seeing right now is really hard to get a lot of these deals done because the debt coverage ratios on a lot of these assets it's below 1.2. That banks want at least a 1.2. And right now, with rents dropping, with NOIs not growing, with expenses going up, a lot of these assets, they have to drop the prices. And some of these owners, they don't have to sell, so they're going to keep their prices elevated. So it's going to be harder to get debt. Now, the great thing about it, and this is the other opportunity is that brokers want to find qualified buyers. They're looking for buyers because there's not as much demand right now. And the buyers are sitting on the sidelines, and brokers are willing and able to pick up your calls. I've never seen in the last 3 years, over this past 6 months, the attention to detail that a lot of these brokers have right now. When you call them up or you sign a confidentiality agreement, how many of you out there have experienced this? It can't only be me. I get a call right back from a broker. Yep, Gino, got the deal. Can I send it over to you? And they follow up with calls to offers. Whereas years ago, they didn't have to. There was so much demand and there wasn't enough supply of deals. Right now, that's continuing to flip, whereas the brokers need you. So don't be afraid. Now is the time to start looking at brokers, calling them up, going on Crexy, going on LoopNet, connecting with them, and making sure that you reach out to them. Now, let me just go back to the problems versus the opportunity. Once again, I really want to stress this. The problem right now is that prices haven't dropped enough to substantiate that debt coverage ratio. And the other problem is right now that rents in the near term, the next 6 to 12 months, maybe not 12, but at least the next 6 months, they're continuing to either drop, stay flat, and there's vacancy issues, especially on the older assets. Now, there's opportunities. Deals are harder to get done as far as financing, but that opportunity means that, hey, if you've got a deal and you can reach out and you can make that deal work, that's what's really cool about it, because these older assets are going to continue to drop in price. The very first thing that you need to do, if you're in real estate right now, you probably know this, and if you're just starting, you really have to, what's the word that I can say? You really have to take heed, because this is important. You need to pick a market. And it doesn't matter what market you pick. Preferably, if you're just starting out, it would be more preferable to try to get something close to your backyard, so you can drive to it. That's what I tried to do. I couldn't do it up in New York when I first started. I ended up having to go to Rochester, New York, which was an hour flight. It was easy to get to. So if I had to get there for the day, I could spend a half a day going to the airport, flying there, and flying back. Was it great? Not really, but that's okay. What I ended up doing was I needed to pick a market because I needed to become an expert in that market. When I started with Rochester, I could tell you the 19th Ward. I could tell you the 10th Ward. I really knew the market in the city really well. I knew prices. I knew expenses. I knew the brokers in the market. I knew what income was. I knew valuations. I got to really be an expert in that market. If you're just starting out, become an expert in one market. And listen, even if you've been doing it for a little while, maybe it's time to focus on that one market. Focus on that market to really learn it. Because within the market, especially if you're in a big city, there are submarkets within that city that all of a sudden you're going to the north side of the city, rents are at this price point, jobs are at that price point. All of a sudden, income is there. Well, when you go to the south side, all of a sudden rents for a 2-bedroom can go from $1,400 to $1,200. And expenses may be higher on the south side. And then all of a sudden, property taxes may be higher as well. Whatever the case may be, just as you're starting out, and you're transitioning from either single-family homes, or you're doing fixes and flips, or you're doing self-storage. I mean, even if you're in that niche, you really need to focus on that one market. And if you're starting out, if you're already in the game, maybe you have that one market, but you're expanding. You're like, hey, Gino, in this sub-market, it's small. It's 30,000 people. Well, expand the diameter, the radius of what you're looking at. That's what you need to do to become the expert in that market. And then from there, the second one is, I would say, I want to put this up. As you're doing that, this should be a 1.5. This is something that I don't want to make this all by itself because it's important. But you really need to learn the brokers. That's why you're really selecting that one market. There's not a ton of brokers in multifamily in each market. The Pareto principle, the 80-20, 20% of the brokers do 80% of the deals. It's incumbent upon you to learn what 20% of the brokers are doing those deals. You want to learn, you want to meet as many brokers. Go on LinkedIn, go on LoopNet, go on Crexy, go on the MLS. Try to meet as many of those brokers, send out contacts, try to connect with them. That's the job. And see what happens if you're into too many markets, it's going to be really hard to niche it down and try to find deal flow in that one market. So stick to the one market, stick to the brokers. Now the second one, this is pretty interesting because most people when they get in, they don't know what they can afford. The second part is really figuring out what kind of deal size you can afford. On our very first deal, Jake and I had X amount of money. We knew that we could afford up to $1 million purchase price. That's what we geared it towards. And if you're starting out, depends upon what strategy you're trying to employ. If you're trying to buy a deal for yourself, well, what can you afford? What kind of balance sheet do you have? What kind of liquidity do you have? And if you don't have a lot, you can go two routes. Jake and I went the partner route early on. We got a partner who had a strong balance sheet. We had another partner who had some liquidity. So we were able to afford more with ourselves, right? And if you can't, and you're saying, well, I don't have the money, I don't have the capital, I don't have the liquidity, don't let that stop you, because there's a couple other areas and a couple of ways you can start getting into multifamily. I mean, the first one would be seller financing. I mean, go to wheelbarrowprofits.com, reach out to the team out there. They have a book called Creative Cash. Great book on seller financing, master lease options, and seller financing. In this part, remember I had kept saying of the market cycle, in this part of the market cycle is starting to work. Because when debt becomes harder to get on these assets and you have more motivated sellers, seller financing becomes more prevalent. So if you're out there, size out what you can get, look at these alternative strategies. And the other one is, what about syndication? What about raising capital for a deal? And if you're just starting out, you may not qualify to become a lead sponsor, but possibly going out and finding people who you can partner with, who you can be on their team to be able to raise capital. It's a great way to get into the deal. And this third one, which really pivots well into what I was just saying, you need to join masterminds, meetups, groups. If this is going to be a long-term business for you in real estate, as in any other business, it really comes down to the network. Do you have a network of investors? Do you have a network of an attorney, a CPA, a cost segregation specialist? You go to these events, you go to these masterminds, you go to these meetups to meet those real estate individuals, whether it's a real estate broker, whether it's a potential syndication partner, whether it's other people in the business that you want to partner up with. You need to spend money on this. And this is one of the mistakes that Jake and I made early on. We didn't do that. We tried to do everything ourselves. And it was very challenging doing things yourselves because you're on an island. You don't know anybody. We were just really fortunate that we stuck into it. We did the first two really well. We chose Knoxville, Tennessee. We really worked hard at that market, learned the market. We really met every single broker. We toured a ton of properties. And then unfortunately, if we had gone to these meetups and done all this work, it would have been a lot quicker. But the only saving grace for us was we created Jake and Gino a couple of years after we started buying assets. And that was quote unquote our mastermind. That was quote unquote the place where we met these investors. It gave us the credibility. We wrote the book. We started the podcast. And that was sort of what our mastermind looked like. Now that was number 3. Number 3.1, which I always think is important, and I should lead with this, but I think it's important for you as you're listening to this. Assess why you're going into multifamily. Should you even be going into multifamily? Is it because you've heard that your friend says single family is just not great because you can't scale, it's too slow, it doesn't make sense, it's harder to manage? Those all may be right. But what you need to do is you need to focus on what you're trying to accomplish. Multifamily for me was phenomenal when I started. I had my goals. I ultimately wanted to leave my restaurant business and go into the multifamily business. I wanted to scale. I wanted to have multiple properties. under my belt. It all worked for me because I understood I had some single family assets and it was very hard for me to scale that entity. I already had the experience. I knew that ultimately I wanted multifamily to become my full-time gig. And that's what it ended up becoming. Is that what you want? Because if that's what you want, it's a great venture. But if you're a doctor, you're an attorney, and you're saying to yourself, I want to get into this business, I just don't have the time. I don't have the expertise. You still need to learn how to buy right, manage right, finance right. But your option may be one of saying, hey, I'm going to get into multifamily, but I'm going to find people who are doing it and I'm going to partner up or I'm going to give my capital to them as a limited partner. That may be the venture. Just so 3.1 is really important. Assess why you're getting into multifamily. Now, as I wrap this up, I just want you to sit back and think of your goals. Think of why multifamily. Think of what it's going to do for you. And as you're doing that, assess the short-term risks, but always think of buying deals, especially when you're first starting out, with the long-term and what your exit strategy is. That's important. That would be a 3.2. Jake and I knew early on that we wanted to buy really quality assets in a good market where jobs were growing, where population was growing, and we could hold these assets for long term, where we could refinance these assets out and or sell them at a higher price, but we wanted to be able to create equity as well as cash flow. Now, if you want to learn more about investing in real estate, investing in multifamily, go to wheelbarrowprofits.com. You can also go to barbaro360.com to learn more about money habits, to learn about money skills. I just became a certified money coach a few months back. I love the space. It'll give you some clarity on how to assess those goals. Should you get into multifamily? Should you stay in single family home? It's really important. Listen, I want to thank you all for spending some time with me here today on the How To Show. I love these shows. I thank you really for spending some time with us, and I'll see you all on next week's How To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.